a brief exercise. This is a pretend company called the Peters Company. Now, at the top of the slide there is an important fact. So this company was only in business for 2 years. And during those 2 years, it entered into the following transactions. So this is a startup. It's going to start up. It's going to operate for 2 years. And then as we'll see next class, it's going to shut down and distribute all its cash to its owners. So we're going to focus on year 1 in this class. So there's 7 transactions in year 1. First transaction, the owners contributed $24,000 in cash. And as you listen to these transactions, try to think about how you would account for them using the balance sheet equation, which is what we're going to do in just a second. Second transaction, at the beginning of the year, we rented a warehouse for 2 years, and we prepaid that warehouse with a rent payment of $12,000. So this is very much like when you rent an apartment and you have to give a security deposit. That security deposit functions as prepaid rent. Third transaction, we purchased $10,000 of inventory on account. And what on account means here is we're not giving our supplier $10,000 of cash when we buy the inventory. We're giving our supplier an account payable, which is a promise that someday we'll pay the supplier $10,000. Then we actually engage in a revenue transaction. We sell half the inventory for $24,000. We get $20,000 in cash for that. And then instead of giving us cash, our customer gives us an accounts receivable of $4,000. So here the customer is saying, someday we're going to pay you $4,000. Fifth transaction, we paid wages of $6,000 and we accrued wages payable of $4,000. So that means that we owe our employees $10,000. We directly pay them in cash $6,000 and we owe them $4,000. And if you think in your own experience, if you ever worked for a company that pays you every 2 weeks, halfway in that 2 weeks, that company owes you money, so they've got an accrued wages payable to you, and they'll pay that money to you at the end of the 2 weeks, a week from now. Sixth transaction, we entered into a contract with Julie's company to sell the remaining inventory in year 2, and as part of that contract, we got a $6,000 cash advance from Julie's company. And then the final transaction that we're going to look at in this class is that we paid a dividend of $1,000. So what we're going to do now, here's a pretend Excel spreadsheet. Obviously, we're doing this on PowerPoint. But we've got some assets. We've got cash, accounts receivable, prepaid rent, and inventory. We got some liabilities. We got AP, which is accounts payable. We've got DEF Rev, which is deferred revenue. We got W Pay, which is wages payable. And then we've got our 2 stockholders' equity components, which are contributed capital and retained earnings, okay? So now what we're going to do for these 7 transactions, we're going to work through and go through these. Now, we're doing this for year 1, but at least theoretically, notice that Peters Company has a balance sheet at year 0.